Welcome to the GraySwan market overview for June 2026. This month the story belongs to global equities and to the United States above all. Let's walk through what happened and what it means for the way we invest. I am Grégoire Theron, Chief Investment Officer at GraySwan, and I will be your guide through this month's markets. June belonged to the global equity market and to the United States above all. The world's shares finished one of their strongest quarters in years, led once more by a small group of enormous American technology companies. The mood was confident, at times euphoric. A blockbuster market debut valued SpaceX at more than $2 trillion on its first day of trading, and the very acronyms of market leadership were being rewritten in real time. Beneath the confidence, though, sits an uncomfortable fact. Shares are expensive. That expense is concentrated in very few names, and history is clear that the price paid at the outset shapes the return earned over the years that follow. This edition looks squarely at that tension and at where value still quietly exists for the patient investor. It closes with how our four funds are positioned for this market. Let's start with the scoreboard. Over the past year, South African assets led the way. Local bonds up 21.5%, and local equities up 18% in rand terms, both ahead of global equities. A firmer rand trimmed offshore returns. But zoom out to 5 years, and local and global equities are almost tied, which is exactly why we hold both. Second, the good news. The S&P 500 was on track for its best quarter since 2020, and the Nasdaq 100 for its second best since 2001. But step back, and the gain is solid rather than spectacular. What really changed this quarter was the mood, not the maths. Third, valuations. The world share market now trades at about 24 times earnings, roughly one standard deviation above its long-run average. And most of that climb has come from investors simply paying more for each rand of profit, not from profits actually growing. Fourth, America is the outlier. The S&P 500 trades above 20 times forward earnings. But strip out the 10 largest companies, and the rest of the market looks close to normal. This is a handful of very expensive giants sitting on top of a reasonably priced market. Fifth, concentration. 3 companies are now worth more than $4 trillion each. Nvidia alone is worth more than the entire top 10 of the year 2000. A generation ago, the giants made hardware and sold oil. Today, they sell intelligence, and there are far fewer of them. Sixth, one sector above all. The concentration isn't only in a few companies, it's in a single sector. Over 30 years, technology has grown from a modest slice of the US index to comfortably its largest part. Buying the index today means buying one theme, more than at almost any point in its history. Seventh, the SpaceX listing, the largest in history, which leapt 19% on its first day to a $2 trillion valuation. Exciting, certainly, but history is blunt. The median major IPO has lost 31% in its first year. A great company is not always a great investment. Eighth, what does all this expense mean? Over a single year, very little. Valuation cannot time the market. But over 10 years, it matters enormously. And from today's levels, history points to modest long-run returns from American shares. Ninth, and more encouraging, value still exists. Once you step outside the United States, the valuation problem largely fades. The United Kingdom, emerging markets, and China all trade near their long-run averages. Emerging markets in particular offer higher company profitability at around a 30% discount to the rest of the world. 10th, interest rates. Both the 2-year and 10-year US Treasury yields have turned firmly higher since early this year. Rising yields are tough on bond prices and lift the bar for every asset. The bond market is bracing for higher for longer. 11th, closer to home. A more hawkish US Federal Reserve lifted the dollar and pushed real yields higher. The rand unusually sits close to fair value, so we expect little further weakness. And gold, last year's star performer, round-tripped all the way back to flat. A timely reminder never to chase last year's winner. Before we close, A word on what all of this means in practice, because our 4 funds carry this month's story as live positions. About a fifth of our offshore equity is protected by S&P 500 put options, insurance against the expensive concentrated market we have described. After South Africa's exceptional year, index puts protect about a quarter of our local equity, so part of that gain is banked, emerging markets. The cheaper half of the world make up nearly a third of our offshore equity. Our income sleeves stay short-dated, collecting today's high real yields, and the currency book is hedged the same way. Deliberately and in advance, while bought call options on our small gold holding add participation if the metal climbs. But it's important to be honest about what this protection is and what it isn't. The put options are struck below today's market, which means the funds take the first part of any fall themselves. The cover only begins to pay once a decline goes deeper. It's insurance against a serious sell-off, not a promise that you won't feel a down market. That is a deliberate choice. Cover struck at today's prices would cost far more and blunt the recovery. That protection carries a cost in calm markets too, and these positions, as at the 1st of July, will change as markets and our views change. That's the GraySwan market overview for June. In a confident and expensive market, our job is a simple one. Stay diversified, mind the price we pay, and keep our discipline, so that whatever the year brings, you can sleep well at night.